For everybody who doesn't know me, my name is Julia Keimbrecht, and I'm on the partnerships team here at Gelt. And I'm very excited to be hosting this webinar today together with our partner, King Operating. So here is what the next 45 minutes gonna look like. In a second, I'll go over housekeeping and introduce our two speakers. And yes, both of them are named Rachel. So we'll do I'll keep saying last names so we're not getting confused here. And then we'll have plenty of time in the end to answer any questions the audience might have. But for housekeeping, before we begin, this is a webinar, so please, you won't be able to unmute yourself. So please paste all your questions in the chat function, and we'll answer them by the end of the webinar. And we'll also want to make sure that everybody is aware that today's content is purely educational and general in nature. So this is no tax or investment advice. And yeah, please don't be shy and ask as many questions as you would like by the end of the session. Okay, and nobody on this call can see your return. So if something you hear today that sounds like it applies to you specifically, the right next step is to schedule a call with either us or the team at King Operating. Okay, and without further ado, I would love to introduce our two speakers. First, we have Rachel Griffith from King Operating. She will take the investment case, why oil and gas, how their programs are structured, and why King Operating specifically. And then after, we'll have our very own Rachel Richards, our head of tax product at Gelt and CPA. She will talk through the tax side, the components of the deduction, and then we'll walk through a real K1, how it's actually going to look like on your return. And I'll pass it over to our Rachel to do a quick introduction about Gelt. Rachel, the floor is yours.
Awesome. So if I know we have a mix of clients in here, so if you're not familiar with Gelt, Gelt is a tech-enabled tax firm. So we have engineers and AI developers working alongside our in-house CPAs to help deliver year-round proactive tax services. And what really differentiates us from other tax firms is the focus not so much on compliance but on year-round proactive planning. So that means if you have an investment that's going to impact your taxes or you have a tax event, we're addressing that throughout the year and helping you identify opportunities instead of just focusing on filing at year end, which is really more of an after the fact thing where you have less opportunities to make an impact on your tax outcome.
Awesome. Thank you, Rachel. And now I'll pass it over to Rachel Griffith. The floor is yours.
Well, thank you so much, Gelt team, and thank you to everybody who is joining us live today, and of course, possibly later on the replay. My name is Rachel Griffith. I'm a Senior Vice President here at King Operating, and I'm excited about the partnership with Gelt. Absolutely love your guys' business model. I like the one-on-one interaction, but yet the AI build out, the tech platform, I think it's absolutely brilliant. So I'm excited to be partnered with you guys. And as Julia mentioned, yes, what I want to do today is talk a little bit about oil and gas, why oil and gas, how might it benefit you, talk about our investment structure here at King and why we're different. And really, what we find is that a lot of successful people, they've found out, they understand how to make money. But now what really happens is the bigger question, how do you make that money work harder for you, right? So at King Operating, we specialize in using oil and gas investment opportunities to really bring a unique opportunity which provides tax deductions, the monthly income, and the opportunity for growth in your portfolio. What's really important to remember is that a tax deduction does not make a bad investment good. but it can make a investment that has good economics even more attractive. And that's really what I know that Rachel's going to talk about, and what I want to talk about is you want an investment that has good economics, that is solid, that is an overall strong opportunity, looking at all the economics. And then when you add that tax deduction on top, that's really where you see that value. So we can go ahead and move on, Julia. Of course, disclosure information. These are forward-looking statements and projections, a lot of them. So we do work with many attorneys. And if you want to move forward with us, we always encourage you to do your own due diligence. Take a look at anything with an attorney or your CPA. Go ahead, Julie. Let's talk a little bit about why oil and gas. And of course, we're going to dive into those potential tax advantages. Rachel's going to share a little bit more about how those work, how they're so beneficial to investors. So we'll get to that shortly. But of course, portfolio diversification. So when you think about adding oil and gas to your portfolio, it's not about adding something that is replacing something else necessarily. You want a diversified portfolio. We usually say that oil and gas should be roughly 10 to 15% of your entire portfolio. That's kind of your alternative asset class. You're going to have your different, stocks, public market options, but really oil and gas, when we talk about the zigzag in a portfolio, is that these things move with different metrics, ideally. So depending on geopolitical things, or depending on economy, the economy or inflation, what is moving in your portfolio that gives you the most balance for the timeline that you're looking at, which is usually till the end of your life. And then hopefully within that is also opportunities where you're building generational wealth. And that's where oil and gas can play a really special part in your portfolio. So long-term income, long-term growth, and of course, potential income, right? So we do pay out revenue. You're going to see monthly income. We used to call it mailbox money. Nobody gets mailbox money very much anymore. It's usually an ACH, but I still like to call it that, right? You're getting that monthly revenue while also giving the investment time to work in your portfolio. It's growing, it's scaling, and then you're going to see an exit, and hopefully you're going to make a nice multiple at the end of that. So that's really where oil and gas can fit nicely into your portfolio. Personally, I like to have diversification where I can't always pull out my money. I can look back at some of the NVIDIA stock I sold in 2023 thinking, dang, I wish somebody would have just said, you can't do it. But, we all live and learn. So sometimes it's very nice when your investment is actually put away, it's building, it's working. You can't just pull that liquidity out, and then you're actually going to see a nice growth nugget at the end of that. So that's one of the things I love about alternative investments. Probably best I don't get my hands in the cookie jar too much. So now let's talk about one of the big picture items here is the essential domestic and global energy demand. We are all very familiar with how things have changed within the AI world over the past several years, and that's not slowing down. We're actually looking at data centers, AI computing, Bitcoin mining is only going to increase. No matter how many states want to try and stop it, they cannot hold back the tide. And so one of the main drivers for that is going to be oil, and specifically natural gas. So there is a huge demand. Of course, commodity prices going up and down. I try to tell investors, look, sure, commodity prices that are high right now, yeah, that's good, it's attractive, but that's not why you should invest. You should be looking at the overall economics, and you should be looking at an industry that has been one of the top industries globally for almost 100 years. So energy is something that we need all the time, and oil and gas provides that to people. Okay, Julia? All right, and I just want to pull this up real quick to touch on why oil and gas, and looking at the last 26 years, because we do see oil and gas go up and down, but it is really cyclical. So when you look at 26 years, the average price of commodities hitting that almost $80 a barrel. So there are times where it's low, times where it's high, but it does work cyclically. And so we do see it always rebounding back up. Honestly, great price point for crude is usually around that 70 The $75 a barrel marker keeps prices at the pump low, but this is just kind of a nice outlook on commodity prices. Go ahead, Julia. So I'm going to talk a little bit here about why King. What makes our model different versus, say, what we would call traditional oil and gas? Now, King Operating has been in business for 30 years here, based in Texas. So we have a long history in oil and gas, and our founder and CEO, his family goes back 4 generations in oil and gas. So he has seen it all. And in 2015, he changed our business model. And the business model is really modeled after private equity, but mirrored after real estate. So if you think about acquire, develop, divest, just imagine you buy a pre-owned home, you add value to it, you put in that beautiful kitchen you always wanted, master bedroom. What are you doing? You're increasing the value of that home, where you can there turn around and sell it and make a multiple on your investment. So we do the same thing here at King. We buy high quality mineral leases. We begin to develop them, scale by increasing the value as we drill. And in 3 to 5 years, we actually exit those locations, sell them for our investors. And that's where they're looking at targeting the multiple. Go ahead, Julia. So, and I do want to mention to anybody watching, we only picked a few slides. These are high level slides. So of course, I'm just touching on some points here and happy to share our full slide deck with anybody after this. But let's just think about the 3 pillars that King Operating offers and what oil and gas offers, which is an unusual and a unique investment. Because number 1, you're going to see the 100% tax deduction, right, over the lifetime of the investment. And we'll get into that further. So tax deduction. Number 2, monthly revenue. And number 3, the opportunity for growth and hitting that target. The 2.8x is what we target on this current fund, which we call KOP3. So King Operating Partners 3 is our current fund. We do plan to have 10 funds in this package. So this is number 3. Go ahead, Julia. So why King Operating? As I just mentioned, 2.8x is our target, but this is a $125 million raise. This is a limited partnership that we're looking to see 3 to 5 years. We plan to exit around that 5th year, and that's when the fund is fully subscribed. We are already currently at $90 million in this fund, and we target to see an exit of about $350 million for our partners, hitting that 2.8 to 3x multiple. Okay, so when we look at the assets, which is really important in any oil and gas fund, I always say to investors, a good question to ask is, have you hit oil? Are you making money? Right? That's something when you're assessing oil and gas that is important, because there are many oil and gas funds where you may invest your capital and it's not going to be deployed for maybe a year or longer. So you're putting your money in, and you could be waiting quite a bit to see any type of return. So our COP3 fund is a producing fund, and I'll start right down in what you see as the Permian Basin. So COP3, this fund launched in November of 2024. That's when it came online. We had about 3 wells in the Permian Basin. Many people might know this area is very prolific in the United States. So we actually put the 3 wells online about 4 months after the fund started, and it started producing some revenues around 2 to 3% right away. So that's actually, for an oil and gas fund, that's pretty fast to start paying out revenue. And then we went ahead and put 12 wells online in there. That took us to about 5 to 6% in revenue. So last year in October, when you go up to Bivens Ranch, we have 60,000 contiguous acres in a proven oil field in the state of Texas. We drilled 2 wells there. Those are very large, what we call horizontal wells. And those wells took us in January of this year to 10 to 11% in revenue. And then if you go up to Anadarko Basin, we actually have 6 wells coming online there. The first one should be online by the end of August. So before we drill in any area, our operations team, we have our full operations team at King Operating. They spend about 3 to 6 months at minimum doing their due diligence in these areas. So they're going to take seismic geology. They're going to look at all the other wells in the area that have been drilled, and they're going to combine that with their knowledge to pick the locations we're drilling in. So we really de-risk this, number one, by having your investment in 3 different locations, not just in one area or a 3-well package, 5-well package. And by doing that, we actually are able to now produce revenue from different assets and give you kind of a diversified, de-risked outlook on where your investment is. So yes, it's cash flowing. Yes, it's producing. And we'll talk a little bit more about returns shortly. Go ahead, Julia. This is an important slide, and we have a lot of other sensitivity analysis and economic slides. But what I wanted to point out here when you're looking at an oil and gas deal is this is going to show you the different locations, formations, how much is the drilling cost, the estimated ultimate recovery for the wells. But what is really important is break even, right? So what does oil and natural gas need to be at for your drilling program to make sense? So for us, one of the reasons why people really like our deal is because we are able to keep our break-even costs low. This is important because this fund does not have any leverage on it. So $35 a barrel, 42 and 45. Now, of course, if oil went to 50, would you make a lot of money? Probably not very much, but these wells still make sense, where a lot of other companies are probably leveraged and they're looking at needing their economics to be between $50 to $60 a barrel. So these are really comfortable numbers for us that we're happy about keeping the economics down for the price of oil and what the wells are being drilled at. Go ahead, Julie. Okay, so I want to talk on this because when you look at oil and gas, again, traditional oil opportunities are done like this. You drill a well or a group of wells. And when you invest, what you're going to get is a tax deduction, and you're going to get monthly revenue depending on how well those wells come online. How much oil and natural gas do they produce? Well, oil wells are a depleting asset over time. They come online strong. They have a curve, which usually you're hoping doesn't go down too quickly. But traditional oil and gas is really one of those investments where you are really banking on getting your money back just from production. So again, going back to our model, what we do is not only give you the tax deduction and the revenue, but in that acquire, develop, divest, you own the assets in the portfolio. So you own the producing asset, you own your pro rata share of the entire leasehold, which is really where a lot of value comes from in oil and gas. It's actually the leasehold and the offset wells that can be drilled once you have a producing well online. So we see the tax benefits, passive income. If we needed to, we could use leverage. I said we don't have any in this fund, but we could. And that exit strategy, right? So that's what I mean. You own those leaseholds, you own those assets. As we scale the value of the entire leasehold and look to sell it, you're actually going to have an exit strategy versus traditional oil and gas. There is no exit strategy. You could get a K1 for 20 years, even if it's, hey, it's $50. So we have an exit. We have a target hold time for you at 3 to 5 years. Go ahead, Julie. And just taking a look at what we've done so far. So again, oil and gas does have a natural curve depending on how the wells are doing and how many more come online. So seeing those 10, 11, 10% dip down, coming back up online now. We've averaged about 8 to 9% over the last 6 months. We're projecting to the end of the year to see 11%. The target for this fund is 9 to 14, so we are already there, and we would see by the end of this year hitting 11% annualized distributions. And of course, 8 to 12 more wells will be online this year. Rachel's going to talk about this a little bit more, but I threw this slide in here just talking about intangible drilling costs. We're going to let Rachel break that down, and the tangible drilling costs that the big beautiful bill gave us that boost on. Go ahead, Julia. Okay, so I just wanted to show this example because this is a really clear picture of what it looks like for you as an investor. If you take a $200,000 investment and we use a deduction factor of 75%, this is pretty modest for us. So you can say 75 to 85, but we'll use 75. What that looks like is a year one deduction of $150,000. So that's on your K1, which Rachel will go through with you. we'll use a marginal tax rate of 40% to see a cash on cash savings year one of $60,000, which of course, if we're looking at building and preserving wealth, growing wealth, that's your 60,000. Throw it back in another investment and let that start compounding for you, right? That's building that generational wealth. So you can go to the next one, Julia. Track record. So with our tax deduction, 82.6%. Last year was 84.6, but even though that says 21 to 25, we have actually averaged that number since 1996. And then just looking at the prior fund that we had before this is 7% in monthly distributions, which I'm actually really proud of because this fund had to launch right after COVID. And let me tell you, that was an interesting journey. And so we're happy with what we've actually achieved there, especially since oil workers were non-essential during COVID. So that was a whole rebuild from that fund. But Rachel, Julia, you can go to the next one. And I'm just going to give this highlight so that anybody watching does understand how our process works. Of course, if you're interested, you can get in contact with me. We'll go through all the information, do a deep dive, and then what it looks like to invest is, of course, you do need to be an accredited investor. And so you would get subscription documents from us. You would get wire instructions, send us the wire. You're going to get your own Juniper Square portal. All of your information is going to be housed in that. Distributions, any important emails that we send out, it's going to have a lot of information also based on how the wells are producing. We'll get a letter of accreditation from you, and you'll be in the fund. So we do have some, I will mention, we do have some preferred positions that are available for anybody looking to invest as we're kind of approaching the end of this fund. So I can talk about that more later if anybody is interested. Okay, Julia, I think that's it on my side.
Thank you, Rachel. Rachel R., it's your turn. Thank you.
Thank you. So when you're thinking about oil and gas investments, the first thing that we really want to emphasize is this is an investment first. So when you're making an investment, you want to evaluate the deal, you want to do your due diligence, and whether or not you invest in something is a separate decision than the tax benefits. One thing we like to say is taxes are the cherry on top. You know, taxes are my life. But taxes shouldn't be running your decisions. And if you're getting a tax benefit from something, that should make something good better. It's not necessarily going to save your deal if you're losing money. So any investment you make is an investment decision first. But there are some really cool tax benefits that come specific with oil and gas investments that you can't get anywhere else. So that is really exciting, and we want to make sure you understand the benefits and the different decisions and things that might play into what kind of tax benefit you'll be looking at. So really, the emphasis before we get into anything else is you're making an investment decision first, and the taxes are just going to make a good investment better. We can go to the yes. So what's different about oil and gas investments? Usually, if you're investing in a real estate syndicate or with other types of investments, if you're generating losses, those losses are typically trapped against passive income, unless this is your, everyday business that you're, hands-on running. So with, for example, real estate, you might be generating losses each year, but it might take 5, 10 years to actually get the tax benefit of those losses. Something unique about oil and gas investments is if you're invested as a general partner, you can get those non-passive losses. So that means it can offset your W-2 income, your ordinary business income, and that income is taxed at your ordinary tax rate, which could be, up to 37% plus state taxes. So sometimes in the 40s and even 50%. So there can be a huge tax advantage, especially in the early years, specific to these types of investments. and how you invest. We mentioned the general partner, which is something that we'll talk about in a little more detail when we look at the K1. But another thing that you want to be thinking about when you're making an investment is how you're investing. So if you're holding the investment in like an S corp or an IRA, that's going to have a huge impact on what tax benefits are realized to you. So in any investment, it's going to be dependent on your situation. Definitely talk to your tax advisor. Make sure your deal is structured so that you're going to be eligible to take any benefits that can flow through to you. So, if you're thinking of owning this in an S corp, that could have a huge impact on whether or not you're actually getting those tax benefits. So, those small decisions can make a big impact on your tax outcome. So that's definitely something that you want to be thinking about and proactively talking with your tax advisor before you're making any final decisions. Um, and then another thing, again, when we get into the K1, we'll look at this a little bit further. But also know, any deductions that you're getting, you probably will pay it back at some point in some other form. So if you're getting a really great deduction in the first year, that can have a huge tax advantage. But it could also do something called reducing your basis, where you would pay more capital gains tax later. So just something as we go through the K1, you definitely want to keep in mind to make sure that you understand the total impact of the benefits and what costs they might cause down the line. Okay. So when you have an oil and gas investment, the first thing that you want to think about is the structure. So how you're owning the investment and what kind of investor you are. There's usually a general partner who has that's called a working interest investment, or you could be a limited partner. It's really important in order to get the tax benefits that you're treated as a general partner because that's going to open the door where you can get that ordinary income and those ordinary losses as opposed to having those passive losses that are trapped. The difference between being a general partner and a limited partner is as a general partner with the working interest, you're getting the tax benefits, but you also are opening yourself up to liability. So there is liability where you could be liable for additional costs. So the tax benefit you're getting is going to be coming with some risk, and that's something that you always want to consider. There's also two different costs that are gonna potentially be passed to you. So there's intangible drilling costs and then the tangible drilling costs. The intangible drilling costs, those are things like labor, drilling, site work. In most cases, it's about 70 to 85% of that initial investment that you're making. And in year one, those costs are going to be fully deductible, which means that if you're making a $100,000 investment, you could have a $70,000 tax deduction, which can make a huge difference in your total tax bill. So that's going to be an ordinary tax deduction as long as you have that working interest. Then there are the tangible drilling costs. So that's equipment, the things that are going to be depreciated or depleted instead of taken as the intangible costs. So those are going to potentially be taken over time instead of deducted immediately or at the partnership level. Sometimes those can also now under the new tax rules be taken immediately. So those are two different types of costs, and we'll see how those flow through to you when we take a look at the K1, which I believe is almost coming up next.
Let me share. Can everybody see it?
Okay. So when we're looking at the K1, the first thing that you want to look at is where we have that number one there. So where it has general partner or other LLC member manager. That's a really important distinction. That one little checkbox is going to differentiate between whether you get those ordinary losses against your W-2 or business income, or you're going to be having passive losses, which could potentially only offset your other passive income or be trapped and deducted against future years. So that's the first thing you want to look at on the K1, and that's going to dictate how your activity is being treated. And honestly, even before you get the K1, when you're actually, entering into this deal, that's something that you want to know up front. The K1 should just be confirming, what's already been agreed upon. So that's something really important to look at. Then we have in the second and third piece, we have your ordinary income or loss. And what's special about this is your ordinary income or loss, because you're that general partner. If you are having that active participation, you have the liability, then the ordinary losses are going to be able to offset your ordinary income. If this number was a positive number and there was a profit, the outcome of that would be that it would be ordinary income and subject to self-employment tax. So it's really good as a loss, but as a profit, it's going to cost you a little bit more. So that's something to keep in mind. And then as we get into the third box, it's box 13J there. Those are going to be your intangible drilling costs. So those are going to be potentially deductible against your ordinary income in the first year. So that's where between the 73 and the 11,000 in the top box and then down in box 13, you're getting about an $85,000 loss that's going to go right into your tax return. So that's a huge tax benefit. Let's see, we also have some alternative minimum tax inputs. So that's highlighted with the 5 there. And we're not going to get too much into AMT, but if you are subject to AMT, these could have an impact on your overall tax outcome. So I just want to highlight that. And then let's see, and then in box 6 or in the 6 area over here, we're analyzing your total capital account allocation. So in here you can see this is the first year of the investment. So $100,000 was invested. We have $84,000 in current year losses. That's going to be the intangible drilling costs plus that ordinary business income loss. We have another adjustment that's for depletion. You have some distribution, so that was some capital that was returned to you throughout the year, and then your ending capital account is about 13,000. What that means is because you got all of these great tax benefits in year one, if you, let's say nothing happened in year 2, in year 3, you exited this investment for $100,000 again. Even though you put in 100,000, you got out 100,000, you would have a capital gain of about $85,000 because in previous years you did get that tax benefit. So when you're getting those tax benefits, it's doing something called reducing your basis, which means that when you exit, your gain or loss will be adjusted for what happened throughout the life of your investment. So one thing we always want people to be aware of is the great tax benefits are going to affect your investment throughout the entire life. And capital gains are taxed at favorable rates. So one thing that's really nice here is you're getting that ordinary loss. So you're offsetting your income that's taxed at the highest rate. And then when you have capital gains, those gains are taxed at a much lower rate. So you're really able to eliminate tax. You're not just delaying it. Okay. Okay. So now we have um yeah, just three things that to keep in mind when you're making the investment, looking at your K1, having that working interest exposure. It does expose you. You do have exposure to real risk. That's also what allows you to get those really great tax benefits. Um, Also, you do have, it is an investment. So think about what you're putting in and what you expect to get back. Your investment decision should happen outside of taxes. And just know that there are loss limits. So if you have, say, a $500,000 loss in year one, that loss may end up being capped due to loss limits that are put in place each year. So it doesn't mean that you wouldn't get to take the loss at all. It just means that you wouldn't be able to take the entire loss in a single year. Okay. And then this is just summarizing the key points that we talked about when we were looking at that K1, and what each of those areas mean and why they're so important. Okay, and here's a just a quick example. So here you're investing $100,000. We had about an $85,000 deduction. On that deduction, we saved about $31,000 in actual tax savings because of that deduction. So really, your out-of-pocket cost of that first year would be a lot less than that $100,000. So just to help visualize the tax advantage, having an $85,000 loss doesn't necessarily mean that your out of pocket is $15,000, but it does still make a really big difference. And these aren't opportunities that you can get with a lot of other different types of investments. Usually, it takes a lot longer to get your money back. Yeah. So before you make any investment decisions, like I said before, I really can't say it enough. You want to make sure that you're doing your due diligence, make sure that this is an investment that's right for you, that you're going to see a good ROI, and ask yourself, would you make this investment if there was no tax benefit? And if the reason that you're making the investment is because of the tax benefit, you could potentially be setting yourself up to be, frustrated down the line. Um, you also should expect to extend your tax return. Sometimes K1s, because you're getting a K1, the timing of when you can file your taxes is going to be dependent on when the partnership files their taxes. So usually you can get a draft K1 to know what to expect, what the outcome will be on your tax return, but expect to file an extension, which is totally okay. There's extensions are not bad. They're something that the IRS lets you do, they expect you to do. It's there to use it. There's no cost to filing an extension, as long as your tax is paid on time. So as long as you know where things stand, it's totally okay to file an extension. And if you don't have your K1 yet, you should file an extension. That's what it's there for. Um, and then just be aware there's, I don't want to get all into AMT because that could probably be a whole session into itself. But if you have a lot of deductions, you could potentially be subject to something called AMT, which is alternative minimum tax. And your AMT loss might be slightly different. If you're subject to AMT, then your outcome might be slightly different, and that's something to go over with your tax advisor.
Okay, thank you both. That was a Rachel Power Hour. I think now we're gonna go into some questions that I see popped up in our Q&A. For everybody who I mentioned chat before, but there is a Q&A section to the right. So if you could paste your questions in the Q&A section, that would be great. So we can all see them. I see one, I believe. Okay, I'll read it out loud. How does the exit look like in this? They mentioned that they're looking to exit in years 3 to 5. Are all the losses effectively recaptured?
Oh, that's a great question. I'll let Rachel dive into it a little bit, but yeah, so when you do have an exit, there's definitely going to be a recapture, and Rachel can talk about that a little bit, which is why we also here at King Operating do have, and have done successfully before, 1031 exchange. So we do offer that for when we have an exit, we will be opening a new 1031 exchange for clients so that, of course, swap till you drop is definitely an option instead of having to deal with some of the recapture. Rachel, do you want to talk a little bit more about that?
Yeah, if you were to do nothing and make your investment and exit, you would recapture those losses as capital gains. One thing to know about the capital gains is that you would likely get favorable tax treatment on most of those. So the tax that you would pay on your gains would probably be less than you would pay less tax on the gains than the benefit that you received from the losses. So you do still come out ahead, but you don't have to do nothing. There are lots of opportunities for reinvestment that can help defer paying tax on those capital gains. So there will be a tax event, but it doesn't necessarily have to mean a tax bill. You can do 1031 exchanges. You can reinvest in other types of investment that can offset those capital gains. They don't go away forever, but you can delay paying the tax on them.
Thank you. I hope that answered the question. And if anybody has questions, you also feel free to always email us after if they don't come up right now to you. But I see one more here. Is the loss limit the EBL restriction, so not applying to Schedule C income or an additional limit because of AMT?
So if that's the overall ordinary business loss limit, that's going to be on all of your ordinary business income in a tax year. So if you had Schedule C losses, those would apply as well. Um, but it's going to be a limitation that's applied on, it's not, it'll be applied on your entire tax return. So it's separate from AMT. AMT is almost like a full recalculation of your tax where you're going to calculate under normal tax rules and then calculate under AMT tax rules, and you end up paying the higher one. So AMT can get triggered if you have a lot of deductions. And then the ordinary business loss limitation is something separate that just limits how many ordinary business losses that you're eligible to take in a year.
Okay, amazing. Thank you. I think there were a couple that were answered by Tal in the chat. Again, thank you both so much for joining us today. And I think I'll let everybody go now, but this is like if you want to reach us on LinkedIn or over email. On the left here, this is me for the Gelt side, and then on the right, Rachel from the King operating side, everything regarding the investment side of things. Thank you again, and let's run it back soon. Have a good one.
Thank you, everyone. Thanks, Julia.
Bye.
Thanks, Rachel.
Bye.